Life insurance is not for you. It is for people who depend on you. Good evening. This is Vladimir Nemchinov with InvestSteady.com. Welcome to another live. Today we're talking about life insurance. When you should get life insurance. The key factor is dependence. When someone depends on your income, when you have children, when you have a spouse relying on your earnings, when you have debt, others should inherit. If someone depends on your paycheck, they depend on your protection. That is when you need life insurance. Life insurance is one of those subjects that is frowned upon here in the United States. Not for the most part. A lot of people know about it, and it's definitely more widespread here than overseas. Overseas people not planning on dying. Yeah, so this is the kind of thinking it has. Even here, people think, why would I throw away money on life insurance? Well, why would you throw away money on your car insurance? Obviously, it's a law. However, is it not throwing away money? Not really, because you pay so little. You pay so little that it covers insurance companies to cover all the accidents of all the people who are insured by them and make nice profit. Okay, so and it's much cheaper than if you have to replace a vehicle on your own. So unless your driving record is not that great. So this is not throwing away money. What about insurance on the house, right? Property insurance. Is that a waste of money? It's a waste of money and if nothing happens. But you don't know if something happens. And if something happens and your house burns down, well, then it's not a waste of money. Let's look at the first question here. And I really, really like it. What do I do with life insurance? You know, when somebody passes, people are grieving the death. But what's worse than grieving somebody's death is that now all of a sudden you have to get up and get a job while you're watching kids so you can pay the bills that left behind. That's the only thing that's worse. Now in this question, it's very, I like it. Yes, somebody passed away, but the question that the surviving spouse has is, what do I do with insurance money versus how do I survive? And this is a big, big difference, and let it sink in. If something happens to you, what will your spouse do? Will they make it? Do they have something to rely on your income is gone and then your family is below poverty and trying to survive? Hopefully you have answer to this question. If not, let's see if we can help you answer that. So here's the question. Burner account here, but looking for advice. 24-year-old with two kids, 11 and 9. Husband passed away and is leaving $1 million in life insurance payout. $1 million. Good. Have 50,000 in cash, 850,000 in retirement, 60,000 in college, 529. Will receive approximately 6,000 a month in survivorship benefits. Sounds like it's different, it's separate from insurance. Mortgage is 630,000 and is a big house that needs work. What should I do with 1 million? It's a good problem to have, isn't it? It's definitely beats. Yes, it definitely not going to replace the husband, but it might replace the income. What should I do with 1 million? I do not plan on working much until the kids graduate, and I'm hoping to live off of the survivorship benefit supplements by some of the life insurance money as needed. I don't know about work after the kids go to college, but thinking it would be nice to just work enough for health insurance and be able to live off of some of the payout. Should I pay off home and save the rest, knowing I will need to spend 5 to 10K a year in upkeep, or sell, pocketing only 150 in equity, and buy a townhome at $550,000? Second option would likely significantly reduce long-term costs, but disrupt kids from the home, etc. Is there something else I should consider? Feeling really overwhelmed with what to do. Again, don't get me wrong, husband passing, it's not something that'd be like, oh, okay, let's move on. She's overwhelmed. But imagine if she had $50,000 in debt, and now she would have to work to support her children, to pay for the mortgage, and to try to get out of the hole of the debt. She definitely in the better options of the two, with constant of passing of the husband. So, all right, she's planning on living on $6,000 a month in survivorship benefits. Okay, so $1 million. She has $630,000 in mortgage, and she's saying it would be better to buy a townhome for half a million, basically pay it off with 150 from equity from the house, plus another $400,000 from the insurance. So yes, definitely you want to be in a position where you can make ends meet without, if you don't want to work until kids are out of college, perfect. You want to make sure that all your money together, you can survive on it and you can live on that for the duration of you staying home with your kids. And this money certainly allow you to do that. So you're making $6,000, so that's $72,000 a year, right? Mortgage is 630. So what I would probably do is I would sell the house, okay, get $150,000 in equity, would take remaining $400,000 from the insurance, and I would buy that hometown. From that point, I have no mortgage. Okay, so taxes and insurance I'm still paying with from the $6,000. I can survive on that. I have $50,000 in emergency. Retirement is still there. It's holding on. The rest of the million, which would be $600,000, could be invested, and that's where budgeting would help. Okay, do you need more money to survive? So your kids, your youngest is 9 years old. So for next 9 years, at least you're not going to be working. You're going to be 54 years old at that point. And if you said until they're out of college, that's probably at least another 4 years. But you're probably going to be bored of your mind. Your oldest will be already gone, probably out of the house. So definitely downsize in townhome. And yeah, the $600,000 remaining from your insurance, invested, even an S&P 500 should earn around 10% annually. So that means $60,000 it should grow a year after year. If you can survive on a $6,000 a month of your survivorship benefit, by all means, just invest that money. Yeah, you can put more into college fund, but $60,000 growing for another 9 years. It's gonna double at least one time in 7 years at 10%. So that's going to be $120,000. I think you have enough in 529 for both of your children. You have emergency fund, and then you can live on that. You probably will pick up some job here shortly, I imagine, with kids growing and maybe first one going to college. But that money, if you need supplemental income, you can invest it into market, basically in taxable accounts where you can take money out without any penalties. It's not going to be your retirement. You can max out your no, you cannot max out if you do not have income. So you cannot put money into Roth IRA. So pretty much your $850,000 will be growing, and at 10% it will be doubling every 7 years. So in 7 years you will have $1.7 million. So you are definitely in a good place, and your husband did a good job taking care of you. And this is why we're talking about life insurance, because there are young people who die for one reason or another, and leaving their spouses with their kids to defend for themselves, essentially. And this is a very, very sad sad place to be in. So I am grateful for this question because it's said in a way that, yes, my husband passed, but now I have over almost $2 million to play with, to live on, you know, and this is a better place to be in. Okay, who should have life insurance? Not everyone needs it. Parents with young children, married couple with shared expenses, people with large debts, mortgage loans, business owners, or sole earners. For example, in business setting, right? If I have a partner and we own business, if I'm passing, he's gonna be partnering with my wife. It's probably not a good setup, and that's not where he wants to be. He wants to be able to buy her out, and that's how you get your business can get life insurance on both of the partners. One passes, the other one, the business gets the benefit of the survivorship or life insurance benefit, and then the remaining partner can buy out the spouse. So this way, now business is only his or that partner's, and the spouse bought out with enough money. Okay, so who might not need it? Young, a single individual with no dependents, people with large enough assets to self-insure. You're a young person, you have no kids, nobody depend on you. If something happens to you, people are gonna miss you, but nobody depends on you. A better example: if my child passes, nobody depends on them. I don't need life insurance on them. I have to obviously bury them. Okay, let's see. And people with large enough assets to self-insure. For example, if you have a couple $1 million that invested and that's throwing off money, and you pass, and your spouse can survive on that and maybe make income and survive, then you don't really need life insurance. However, depending on your age, it would be pretty cheap, if you're young, 20s, 30s. All right. Let's do next question. Term life insurance options for 2026. What the best ones out there? I haven't really gotten to get my own life insurance yet. But now I'm married with a kid on the way. I want to make sure they are taken care of if something happens. I've known for the longest time that term life is the way to go, but I want to know which companies are most of the people rely on. I see names like Heaven Life, Besto, Policy Genius, but I'm wondering if I should stick with traditional insurers like Northwestern Mutual, State Farm, etc. What term life makes the most sense? 20 versus 30 years. Also, how do you figure out how much coverage you actually need? Some say 10 times salary, others say 15 to 20. And about medical exam thing. Some say they offer no exam policies, but are those more expensive? So a couple of good questions. I mean, obviously, I'm an insurance agent, life insurance agent, so I can help out for those people who need. And the goal is really of the agent is to educate why somebody needs it. Do you need it? You might not need it. Again, for examples I just brought up, you might not need life insurance. So it would be not fiduciary for me to actually sell you life insurance. Okay, but when you do need it, you do need it, and I will tell you. You're young, you have kids. You need life insurance. Okay, so in this example, they're asking about company. Obviously, I'm insurance agent with my company, so I can help you with that. But what you need to look at is not the name of the company, but the policy. What does the policy cover? Do they do payouts? Or are they trying to get out of it any way possible? I've been at the jobs when I learned about life insurance, and I read my work policy, right? A lot of people say, oh, I have insurance with my job. The problem with that is if you move to a different job, that insurance doesn't go with you. And now you're covered at the older age, and it's going to be more expensive. There's a lot of hoops. That insurance would be basically you have to die at work at your desk for you to have, for your spouse to get something. And it's maybe 1-2 times of your salary. That means you can survive 1 to 2 years on that, and then you're back to zero. All right, so what's better, 20 versus 30? Rule of thumb is while your kids are young, okay, so if you're done with your kids and your youngest is 1 years old, so a 20-year term policy would be plenty sufficient for you. But you always know if you're 20 at that time. I was around 30 when we were buying our insurance, right before our firstborn was born. So you can always get a longer term because you're never going to be younger. It's never going to be more affordable for you. And then you can stop paying it down the road, right? When kids are grown, you can stop paying that. Or you can continue and keep that policy open up. There are different structures for life insurance, but the main thing you want to know, it's term life insurance only, and not whole life, universal life, all of that nonsense. That's a scam, and we're going to talk about it right now. Why is it a scam? Term versus whole life insurance. Term insurance, temporary protection, lower cost, pure insurance, designed to protect income during working years. Whole life insurance, permanent policy, much higher premiums, combined insurance with cash value component. Insurance should protect risk, not pretend to be an investment. And whole life is very much pretending to be an investment. People sell it as an, oh, don't just throw away money on term, like you throw away money on your vehicle insurance or your property insurance. No, but it's going to generate some income, it's going to grow, and you can borrow against it. And borrow is the key word that we need to watch out for. Let's look at next question. How do I choose term life insurance company? I went to State Farm and got a high quote, and so now I need to choose among the million other life insurance companies. How on earth do I choose the best one? I can decide how much and how long, but I want to know it's a good company without some weird shady terms. And that's the key. The terms is what you need to know. You need to check, make sure that those terms are good. Obviously, if you know somebody, you can ask. If you ask ChatGPT, I'm sure you can compare different terms and their policies pay out and what's going on with all that. But you need to have somebody who's on your side, who's not going to sell you life insurance because they're agent, but because you need it. You and your family need it, and you depend on it. So we're going to talk about the 4 math problems with whole life. So the 4 of them: how long it takes to accumulate cash value, rate of return of the investment portion, borrowing from the policy, and what happens to the cash value at death. And those are indeed horrible math problems with cash or whole life insurance. How long it takes to accumulate cash value. Early years mostly pay fees and commissions. Okay, so in the beginning, the agent gets money, the company gets money. There's no growth. Cash value grows slowly at first. For like 3 to 5 years, you have zero. You have zero to borrow against. Many policies take years before real value appears. And that's the case. You have to, on average, take 3 to 5 years before you see anything accumulates. But you're paying all that money. Where is it going? To your agent's pocket. Early growth is much slower than people expect. Okay, rate of return on the investment portion. Returns are typically modest. By modest, I mean low, right? So your S&P gives you about 10% on average, and these returns are 3 to 4%. Okay, very low. Lower than long-term stock market averages. Opportunity cost compared to investing separately. So that's why I recommend to protect with term life insurance and you invest. Okay, once you got to that step, in the wealth game, level 2 is protect your income. Then after that, step 3 or level 3 is to save small emergency fund of $1,000, then pay off all the debt, then increase the emergency fund to 3 to 6 months of your expenses. Then you put money into retirement. You put money in retirement. Then you don't need life insurance at some point when you're self-insured, borrowing from the policy. Loans are taken against your policy. Interest is charged on those loans. If unpaid, loans can reduce the death benefit. Borrowing from your policy isn't free money. Let's say your benefit is $100,000. If my spouse, if I'm passing my spouse getting $100,000, right? This is the premium, not the premium, but the benefit, right? And then you have by some miracle, you have $100,000 in the investing portion of it. You borrow 50,000 of this, okay? I'm borrowing, and if I'm passing, my wife gonna get the benefit of $100,000 minus what we owe on it. So she's gonna get only $50,000, okay? And when I pass, if we don't borrow anything, she's going to get $100,000, let's say, right? But this $100,000 gonna go where? It's gonna stay with the company. So all that promised income or investing while you protecting yourself going to the company. You can borrow against it, but another thing, when you borrow against it, you pay higher interest than it's actually earning. And you're not paying it to yourself, you're paying it to the company. So that's the sad part of it. What happens to the cash value at death? Beneficiaries usually receive the death benefit. The initial cash value generally stays with the insurer. With the insurer. That's crazy. Many people assume both are paid out. No, not 100,000 and 100,000 paid out. Only 100. Big scam. Your family typically receive the death benefit, not both benefit and the accumulated cash value. And this is the horrible, horrible thing about whole life insurance. Need advice with life insurance payout. Hi Reddit, I am seeking your advice on a life insurance payout my dad left for me. About 138K. Details. I'm 23 years old male. I start a full-time position tomorrow, making $77,000. I need to get an apartment in a few months after my stepmom sells the house. I was doing some research and thinking about splitting 100,000 and putting 50K each in two different high yield saving accounts. What do you all think? And then keeping some liquid in my personal account to get car, old one's transmission went out, and find a place to live. Appreciate any advice you can give me. So there's a lot of variables that I don't know. For example, where they live. They live in the Cleveland area. They can probably buy a property with that money. If they just new to that, they don't want to buy a property. They want to be renting for the first several years to get on their feet, to know how to pay bills, right? They want to have no debt. So if they have any debt, pay that off. Live on $77,000, good salary at 23. Man, I wish I had that at 23. So these are the things that can be done. From there, just follow the wealth game. First step, budget. Figure out how to live on $77,000. Second step, protection. Nothing about kids or spouse. Don't need that at that time. $1,000 for emergency fund. If you obviously you're gonna have more money, but if you have any debt, pay off debt next. Put away that 3 to 6 months of expenses into high yield saving account. Let it sit there. Next, put in your retirement. If your company provides 401k that they match, put up to the match in there. You're supposed to put 15% of your gross income into not emergency fund, but retirement account. Okay, whether it's 401k, if they don't do it, open it for yourself. Roth IRA, max that out. So you're gonna have less than $7,000 will be 10%. So you can put more. You can max out Roth IRA, and after that, if you don't have 401k, you can put it into taxable account, so that grows for your retirement. Or you can not do that yet, and then live for a year in an apartment and then see the area. And in the year after your lease is over, buy a property, buy a house somewhere. Again, if you live in an area, you can buy a house with $100,000 down payment, easy, any day, every day. Okay, let's see. So, what about you guys? Do you currently have life insurance? What is your coverage? And when did you get it first? At what age or in what position in your life or status in your life? Did you have kids? Did you just get married? Were you single? At what point did you get life insurance? All right, next one. Let's see what we got. Feeling so stupid for buying into the whole life insurance scam. What's the best way to cut my losses? Unfortunately, some people get tied into it and then they pay for years, and then, yeah, it's a mess. I was connected by a fiduciary from Mass Mutual, and they sold me on the whole life thing. They pitched it as, oh, if the market is down when you retire and want to take cash out, you don't want to withdraw in a bad market. It's absolutely insane. $10,000 a year. I got the email that it was time for the second payment of the $10,000, and I decided to do more deep diving in. That's where I found out it's a scam. I'm a high earner in my late 20s, so that's how he sold it to me. If I were to surrender the policy, it looks like I'd lose $8,000. Is it best to surrender now or to keep contributing to it until I break even? Are there lawyers for this, since he didn't act in my best interest as a self-proclaimed fiduciary? Oh man, this is a very hard question, because you signing the paperwork, yes, they didn't say it, they lied to you essentially, but you signed the paperwork, and always read the paperwork, always read the policy that you're signing. In addition, he sold me on a $2 million term life insurance plan when I have no family or anything, pitching it as that's my health is in its prime, so it'll be cheapest now, thinking if I should cancel that one too, but I don't know because I'll get married in the next 2 years. Okay, so a couple of things going on here. First of all, 2 million term life insurance. You're a high earner. I don't know what that means. You should have 10 to 12% of your or times of your income. So if you're making $100,000 or $200,000, $2 million term policy is actually about right. So look at it. You are late 20s. You want to get married in 2 years. That insurance, I don't know how long ago you got that policy, but it's only going to get more expensive. You high earner, so 2 million shouldn't be too much for you. I'm insured at almost $1 million, and it cost me $150 a month. So this is $2 million, and you are, let's see, I'm trying to think, how old was I? You are younger than I was when I got that, so it should cost you like $100 probably, maybe $150 as well for $2 million. So I would keep it at that, depending on the term. How long is it? 5 years? Maybe not worth it. Maybe you need to get a better one when kids come around. Okay. Now with the whole life insurance. So you asking me if you should pay $10,000 more into whole life insurance, which you know it's a scam, so that you don't lose $8,000? It doesn't make sense. So you pay $10,000, so now you don't lose $8,000 and you're at zero? I don't understand. Unfortunately, we have to cut our losses. If you had people depending on you, I would say for you to actually do not. You open the term life first, and when that one kicks in, then cancel it. But now nobody depending on you, so I would just cancel it and count my losses and to call it a stupid tax. I learned it's a lesson, and I'm going off of that. So that's what I would do in this situation. And this is probably it, guys. I appreciate you joining in, watching this. Hopefully it's It's helping you to learn and to improve with all your finances on your money wealth or wealth game. Let's level up, guys. What level are you on? Insurance should protect your family, not complicate your finances. Remember to invest steady